Hello guys, and welcome to this new video in which we're gonna talk about one of the most basic trading strategies, which is the simple moving average. So the simple moving average, for those who don't know, is an alpha seeking strategy, aka the aim is to generate positive above market return independently of the market direction. Generally speaking, moving averages are one of the core indicators in technical analysis, and there are a variety of different versions. The SMA is the easiest moving average to construct and is simply the average price over the specified period. So a shorter term SMA being higher in value than a longer term SMA signals a long market position, and the opposite signals a neutral or short market position. And the rule generally is that to go long whenever the shorter SMA is above the longer one, and vice versa. SMAs are often used to determine trend direction actually, and if the SMA is moving up, the trend is up. If the SMA is moving down, the trend is down. For example, a 200 bar SMA is a common proxy for the long-term trend. 50 bar SMAs are typically used to gauge the intermediate trend, and shorter period SMAs can be used to determine shorter-term trends. In our example, we're gonna follow works with end-of-the-day closing data for the Euro-USD exchange rate, as provided in this data here. So let's get started. What we first need is to import Panda as PD. We're gonna need the pandas data reader to read data from yfinance, and apparently it seems that I need to import yfinance and use this option because I had some errors before, so I corrected it using this that I found online. So we're gonna use data from 2010 to 2020, for example, and to do so we're gonna read the data using get data Yahoo from the Panda data reader, and we'll give it our start and end date. So let's go. Now we have the data here. Let's see some metadata regarding this data. So for example, if I do info, I can play with my data, see the types and the data. What matters for us here matters for us here is just the data regarding the close. So we're only gonna take the close here. As you can see now, we only have the close, and we're gonna rename it. We're gonna rename it to get only the. We're gonna rename it as the price. So data.rename. The columns will be equal now to. So we're gonna rename the close as the price because it's the closing price and it's the price we're using. So to simplify things, in place equals true. Oh, because it's okay. Perfect. So now let's calculate our SMA. So to do so, we're gonna calculate two SMAs, one short moving average and one long moving average. So SMA, the first one is gonna be the shorter one. We're gonna use a 50 days rolling average, for example. So to do so, we need the price, which we're gonna roll using the rolling pandas function applied to the price, and the rolling, it's gonna be the mean, which is the average. And we're gonna do the same, and now we're gonna get our longer period SMA, We're gonna use 200 days, for example, and we're gonna get the mean, and we want to get our mean here. So let's see the data that we have now. So as you can see here, we have the 50 days moving average here, and we have the 200 days moving average here. So let's continue our analysis. We have a little problem here, which are the first data is set to none, so we're gonna have to get rid of that probably, or not. So we won't care for now, let's do it later. So let's visualize our data. So we'll need to plot this. So the title, it's the Euro USD. And let's go. Let's make our figure bigger. Okay, so as you can see here, we have the so we can see here both our moving averages. So the next step will be to generate the signals, aka our market positionings, based on the relationship between these two SMAs here. So the rule, as we explained before, is to go long whenever the shorter SMA, which is in this case the orange one, is above the long one. So for example here, and vice versa, which means to go short whenever the longer one, aka the green one, is above the orange one. So being able to directly compare the two columns of the data frame objects makes the implementation of the rule just one line of code. So let's go. So our position will technically be, we're gonna use numpy, so I will need to import it. I guess I didn't do so, so import numpy as np. We're gonna use this function. So whenever the data SMA1 is bigger than the SMA2, our position will be long, otherwise it's gonna be short. Oh, sorry. Invalid. So one is float and the other is st. Oh yeah. Okay. Okay, now we have our data. So what we need to do now is we need to drop these this NA value. So we're gonna use drop NA panda function and in place equals true. So we drop that data for a cleaner data frame. And now as we implemented our rule, let's plot our signal, yeah. Let's plot the signal, okay? So data, which is the position. Oh. So as you can see, this is our signal, and it signals whenever we need to go long or whenever we need to go short. And so to calculate the performance of this strategy, we'll need to calculate the log returns based on the original time series. So to do this, it's a rather easy and simple code. So to get the returns, so we're gonna use the log returns here. So the data price, so the price divided by the price, shifted. So what we technically did here is we're getting tomorrow's prices and we dividing it. Yeah, sorry, I always do this. Perfect. So what we technically did here is these are tomorrow's price, the price for tomorrow, and this is the price for today, and we're dividing it. And since it's the log, it's actually we're calculating the returns because it's a minus in log. So now let's print our logs, our logarithmic returns. Our figure size is 10.6. So now we can see our logarithmic returns. And now to get our strategy returns, we'll need just to multiply our position column, say shifted by 1 trading day, with the returns column. Since the returns are additive, calculating the sum over the columns returns and strategy provides a first comparison of the performance of the strategy relative to the base investment itself. So let's do our comparison. So data strategy, so the returns of the strategy, data position, and we're gonna shift it by 1, and we're gonna multiply it by the returns. Now we got the returns for our strategy, the logarithmic returns of the strategy from the positionings and the market returns. And now let's just sum up the single log return values for both the stock and the strategy for illustration's sake. Sorry, just and let's apply the exponential. We need to apply exponential on this because since these are logarithmic returns to get our gross performance here. So as you can see, our strategy is way much performant than the market returns.